Ready to dive into the heart of the U.S. economy. Today we're tackling the national debt, the Federal Reserve, and maybe even a theory or two that might sound a little, well, out there.
It's a jungle out there, all right, but we'll try to make some sense of it all.
I like that. So let's start with the elephant in the room, that national debt. It's a number you hear thrown around a lot, but what's the deal right now?
Well, right now it's hovering around $35 trillion.
$35 trillion. That's
A hard number to even imagine. Think of it this way. If every single person in America owed $100,000,
Mhm.
that's about the scale we're talking about. And a big chunk of that comes from things like the 2008 crisis, then the pandemic. Both times, the government had to borrow, borrow, borrow just to keep things afloat.
So it's not just some abstract number. This debt has real consequences.
Oh, absolutely. Think of it like a giant credit card bill, a really giant one, with interest rates that never stop.
Yeah.
And that interest, that's money the government has to pay, which means less money for, well, everything else. Roads, schools, you name it.
So it's a balancing act with a lot at stake. Now, let's talk about something I've heard called the manufactured crisis theory. It almost sounds like, I don't know, something out of a movie.
It has a certain ring to it, doesn't it?
So what's the theory, and is there anything to it?
Well, it suggests that the government might actually want an economic crisis
Hold on, they want a crisis. Why would they ever want that?
because, and here's where it gets interesting, a crisis could be a way to refinance all that debt.
Refinance it. How?
Think about it. If the economy tanks, the Federal Reserve, they're the ones who control interest rates. They'll probably slash those rates to get things moving again. And if rates are super low, well, the government can swoop in, issue new debt at those low rates, and boom, their borrowing costs just went way down.
So they're playing a risky game.
You could say that. Whether it's intentional or not, well, that's debatable. But what's clear is that governments and those central banks, they have to make some tough calls when things get rough.
That's a lot to unpack, but I think I'm getting it. You mentioned the Federal Reserve, interest rates. How does all of that factor into this whole debt situation and the economy in general?
The Fed and those interest rates, they're powerful tools. Lowering rates can be like a shot of adrenaline for the economy.
Oh, so.
Well, when rates are low, businesses are more willing to take out loans, expand, hire more people. People like you and me, we might take out a loan for a house, a car, whatever. All that spending, that gets the economy hunting. But there's always a but.
I was waiting for the but. What's the catch?
Inflation. If the economy gets too hot too fast, prices start to rise. Demand goes up, supply struggles to keep up, and suddenly everything costs more. That's part of what we've been seeing lately, and it's why the Fed has actually been raising rates, trying to cool things down a bit.
Right. And everyone's feeling that at the grocery store for sure. But how does this all loop back to that manufactured crisis theory, and why is everyone so worried about it?
Because that's where the theory takes a darker turn. Well, if the government did trigger a crisis, just to force those rates down, it could really fan the flames of inflation. We're talking about a potential hyperinflation scenario.
Hyperinflation, that has a scary ring to it. What would that even look like for everyday people like me?
Imagine going to the grocery store, and that same bag of groceries that cost you, what, $50 last week, now it's pushing 100. And it's not just groceries, it's everything. Your savings, they don't buy what they used to. It's like the value of money itself is shrinking. That's hyperinflation, prices spiraling out of control.
Sounds like a recipe for chaos, honestly.
It can be. History's full of examples, unfortunately. Weimar Germany, that's the textbook case. But even more recently, look at what happened in Venezuela. It can be devastating, not just for the economy, but for entire societies.
That's pretty sobering. So we've got this massive debt, this theory about a manufactured crisis, and then hyperinflation looming out there. What's the government doing about all of this?
Well, one thing they're considering is issuing long-term bonds, like 20, 30-year Treasury bonds.
Okay, break that down for me. What are treasury bonds, and why would that help in this situation?
Sure. Basically, a Treasury bond is like lending money to the government. You give them money, they promise to pay you back with interest after a certain number of years.
Sure.
And those longer-term bonds, they usually come with higher interest rates, supposed to make them more attractive to lenders.
So the government's trying to lock in these lower rates for decades by offering these long-term bonds.
That's the idea. They'd issue these bonds when rates are really low, maybe during one of these manufactured crises, if that theory's true, and that locks in those favorable rates for a long, long time.
So it's a gamble on those rates staying low?
It is a gamble.
Yeah.
And it's not even a new one. After 2008, they did something similar, issued a lot of long-term debt at really low rates.
Did it work?
It's hard to say for sure. In the short term, sure, it helped them manage that debt, gave them some breathing room.
Yeah.
But long term, especially with inflation acting up like it is, it's still an open question.
So it's a tough spot to be in. No easy answers. Let's turn to our listener for a minute. What can they actually do with all this going on to try and protect themselves?
Well, I always have to say, I'm not a financial advisor, so this isn't financial advice. But knowledge is key, right?
Hmm.
The more you know, the better you can navigate all of this.
Where do we even start?
Diversification is always a good starting point. Don't put all your eggs in one basket, so to speak.
So spread your investments around different types of assets.
Exactly. Some things tend to do all right during inflation. Real estate, for example.
Property usually holds its value pretty well, right?
Right. And then there's gold. That's considered a safe haven asset. Tends to hold up well in times of uncertainty.
Interesting. Time to break out those old gold coins, maybe.
It's more about thinking strategically, making sure your assets are allocated in a way that makes sense for you. It's always best to do your research, talk to a professional, someone who understands your situation, your goals, your risk tolerance, and be ready to adapt because things can change quickly.
Flexibility is key.
Absolutely. There's no magic formula. It's about finding what works for you.
This has been really insightful. Thanks for walking us through all of this. So, to sum it up for our listener, what are the key takeaways they should keep in mind?
Well, that national debt, it's not going away, and it affects all of us. The Federal Reserve, they play a huge role, those interest rates, inflation, that's all connected. And even if that manufactured crisis theory seems far-fetched, well, it makes you think about the bigger picture, right?
It does. A lot to digest, but you've given us a great starting point. You've given us so much to consider today.
It's a complicated issue, but it's important.
It really is.
Yeah.
A huge thank you to you, expert speaker, for diving into this with us today.
Happy to be here. Always good to have these conversations.
Absolutely. And to all of you listening, thank you for joining us for this deep dive into, well, the U.S. economy and everything that comes with it. We've covered it all, from that mountain of debt to the Federal Reserve and their bag of tricks.
And don't forget about that manufactured crisis theory.
Oh, right, that too.
We can't forget about that.
Can't forget that one. It might seem like a lot, but hey, knowledge is power, right? The more you know, the better prepared you'll be no matter what's coming down the road. So stay informed, stay curious, and we'll see you next time for another deep dive.